All right, good evening and welcome to all of you. And I hope you guys can hear and see me. If you can you type one in the chat box so I know that you can see and hear me? All right, great. And without much ado, let's get started. And again, this week has been a little bit different from the last 4 weeks because we have seen equity prices finally easing back. And that could be setting a stage for a complete reversal of the gains that we have seen since the end of June. So we can see that the last few weeks of rally is classified largely as a counter trend rally within the bear market. So at least in the daily time frame, that is the case. For the weekly time frame, most of the outlook, the technical outlook remains that the market remains very much in the bullish phase. We have not seen wholesale sell-off in equity markets. But what's more interesting is we are almost going into the end of August, which I remember telling you guys that I think somewhere in the end of August, ideally within the last week of August or the first week of September, we should see a dramatic move in equity prices. So will that be a reversal back upward again or a complete unraveling of the counter trend rally that we have seen so far? Okay, so that's where we are right now. Let me see if I can get my screen back up. Can you guys see my slide? Because I can't see very much what's happening outside. Hang on. Okay. So before we get started, let me reiterate what I need to get through this as a disclaimer. This presentation is by no means an offer for you to buy or sell, as an offer for me to buy or sell to you any kind of financial instruments. And the trading of derivatives, be it option, futures, CFDs, FX, they are all highly leveraged products, and do be aware that these products do carry risk of loss, and you are hereby have to know that you have to know your own risk tolerance before you attempt to embark to trade any of these leveraged products. And there will be a big segment in which I'll be sharing with you my views, and those are my views and have got nothing to do with my company, Traders Academy International Private Limited, and therefore my directors and myself will not be held liable for any kind of action that you may take as a result of attending this presentation. Okay, so let's get started with what has been released in terms of economic numbers this week. We'll go country by country. On Monday itself, we have Japan releasing their GDP numbers. It was not as good as what they expected. They expected a 0.6 increase in the GDP, but it was a lot better than the first quarter of this year, which is negative 0.1%. So by and large, we can see the Japanese GDP has not suffered too much. Okay, yet as far compared to, let's say, UK or even the US. So as far as Japan is concerned, yes, GDP has not been fantastically doing very well over the last few decades. You can see 0.5 is nowhere you cannot categorize 0.5 growth as a fantastic performance. But when you compare it to what the rest of the world is facing, you can give the Japanese a pat on the back saying that they have done a relatively good job, okay? So, but it wasn't fantastically a very robust number, okay? So over in China, we can see that they reported their retail sales. Again, it was less than ideal. They were expecting a 5% growth compared to the June number of 3.1. It came in only 2.7, about half of what the market expected. So we can see the Chinese economy is obviously slowing down. Spending at the retail level have cut down dramatically, and it wasn't as rosy as what market participant was hoping to see. So we can see China as a whole is definitely slowing down, and this is bad news. During the 2008-2009 global financial crisis, at least China came in to fire up their engine to at least keep the global economy afloat. This time, when you can see the rest of the G7 countries are not doing well, and then China is also in trouble. So basically what we are going to see likely if the economic environments take a dip for the worse, this time there will be no country big enough to save us. So we are right now in a situation in which you're flying at 30,000 feet above, and then one engine failed and the other engine is fluttering around. So it is definitely not a very comfortable environment to be in, because when both engine fails, then we will be gliding until it runs out of fuel, and you know what will happen next. So definitely we are not in that situation in which we can say that there will be a big enough economy that will come, to rescue us. This time I think the situation is quite dire. Okay. So over in Australia, we have employment numbers. Again, the employment numbers was terrible. When you look at the employment change, means in terms of how many jobs has been gained or lost, they were expecting a gain of 25,000 new jobs. What came in was a disaster. It came in, they actually lost almost 41,000 new jobs. So it was a terrible number as far as Australian employment change is concerned. Then you can see that although the unemployment rate stays relatively stable from 3.5% for the month of June, is now at 3.4%. So as far as the unemployment rate is concerned, we cannot see how bad it's bad. But when you look at the employment change, it is a disaster. So going forward, we also know that Australia is not going to be doing too well. When you raise interest rate too fast, too soon, okay, what is going to happen is that the employers are going to be very selective, and they may not have the capacity to actually pay the market rate for workers that they need. Okay, so because when you raise the cost of money, it will impact not only the individual, you will impact the corporation as well. So this is going to be a prelude of what we are likely to see in the States. In the States, we see employment numbers still very, very healthy. Okay, when you look at the non-farm payroll that we saw at the beginning of the month, it was a fantastically good number. So what the market expect now is that the Fed will continue to hike interest rate as aggressively, okay, as before the non-farm payroll number is released. So if that is the case, what will be the end result? The end result the Federal Reserve would like to see, to know that they are at least having some kind of impact on the inflation front, is to see a downturn in employment. So going forward, there will come a time in which unemployment will start to rise again. Okay, and if that is the case, then the Federal Reserve can say categorically that they are on the way to defeating inflation. So that is a very, very dangerous assumption, because like I said many times ago, this inflation is very different from traditional inflation that we have seen so far. This inflation has got very little to do with demand. It has got everything to do with supply. And of course, last week, something else happened. The Biden administration has actually I'm not sure whether it has become law or not, but at least the Democrat Party has actually pushed through a new package called the Inflation Reduction Act, okay, amounting to something close to $739 billion. Yes, the headline of this bill is called Inflation Reduction Act, but it has very little to do with inflation reduction. It is basically a regurgitation of Biden's favorite program called the Build Back Better. Okay, it has some component dealing with inflation, but the bulk of it is all about climate. Okay, so from day one, Biden is promising to actually reduce fossil fuel, to go carbon neutral, and this new act called the Inflation Reduction Act is basically a relabeling of this idea that he has under the name of inflation reduction. Okay, and for all we know, experts were saying that yes, at best we can see a 0.1 reduction in inflation, but on the flip side, it may also cause a 0.1 increase in inflation. The bulk, more than 10% of this bill, is to beef up the tax authority, basically the IRA. Okay, they need to employ more agents, and this agent will be armed agent. They are tasked, okay, to go down and hunt down taxes. Okay, which is something very, very interesting, because Biden said that those who are not earning more than a certain amount do not have to worry about having to pay higher taxes. But if that's the case, why put aside $80 billion of this budget into hiring new agents to go after taxes? They say that there's going to be a new tax, a minimum tax for corporation with 15%, and that over the longer term will have impact on manufacturers and companies in the States, in which they will be less likely to have the ability to expand their operation. So I think at the end of the day, the higher cost will be passed on to consumers. So not sure how this thing is going to pan out, but I think it's going to be a disaster, very much like what Biden has been doing over the last 1.5 years. Okay, every major budget that he pushed out seems to be pouring more fuel into the inflationary story. Okay, so let's continue. Over in New Zealand, we have the interest rates. They have again high interest rate by another quarter point. This time it's 3%. Do you see that New Zealand is one of the very first, or at least the Reserve Bank of New Zealand is one of the very first to actually took action to mitigate the rise in inflation. So despite bumping up the interest rate from 0.25 to 3%, from October last year to July this year, we can see that New Zealand inflation continue to surge. Obviously, it's not working. And even if they continue to bring inflation to 6%, I do not believe it will cause a dent in inflation. Okay, so definitely they are not seeing the results. So they thought maybe they're going to double it down to see if they can bring down the inflation. It's going to make matter worse. All central bankers think alike. That's what we are concerned with. That's what we are concerned right now. Nobody is thinking out of the box. Everybody has the same mentality, using interest rates to fight this inflation, which has got nothing to do with demand. Because when you're high interest rate, the way most central banks are doing, they are basically destroying consumption. Okay, they're destroying demand altogether. Okay, so over in the UK, we also saw the unemployment situation. Unemployment, they were expecting more people to claim for unemployment benefit to the tune of 32,000 people, but it came in much less than that. Maybe 1/3 of it was only 10,000 unemployed came in to actually claim the unemployment benefit. Unemployment rate stable at 3.8%, so that one we do not see much of movements there. Of course, later on we will also be showing you the CPI. This is the CPI numbers. So over in the UK, CPI officially now is in a double digit, is 10.1%, and the Bank of England is also one of the very first to start hiking interest rates to tame inflation, right behind the New Zealanders. Yet this is what we see, 10.1%. So UK economy is definitely suffering under high prices. Made worse by Brexit for one. The timing of this Brexit was just so horrible, because with the moment they pull out of the Eurozone, then we have this COVID-19, and then followed by the war in Ukraine. So everything is all wrong timing for the UK, and now they are suffering. Can you imagine, they are running out of truckers. Because before Brexit, most of the people who actually drive the trucks are from the former Eastern European states. When UK is part of the Eurozone, all these migrant workers could actually work in the UK. Now they can't. So there was a period of time whereby there was a very serious shortage of truckers. Ship that brings goods into their harbor cannot be unloaded because they simply cannot find enough truckers to unload those goods. So we can see this is compounding the problem, and it is not just the UK. Elsewhere, of course, there was no Brexit, but similar problems were also seen because China has employed very severe COVID-0 policy that caused a worldwide reduction in supplies. Okay, so this is going to fit into the global inflationary story. So CPI in the UK has gone from bad to worse. Now it's at 10.1, and even the Bank of England has admitted that they are likely to see 13% inflation going forward. So 10% is only scratching the surface. I think there is going to be more severe inflation escalation before it comes back down. Okay, so for the rest of this year, I think it is almost a gone case for the UK to actually bring down inflation. In the Eurozone, we have the GDP numbers. They were expecting a slightly better number of 0.7% growth. It came in slightly under, but not so bad. It means it's stable at 0.6. Q1 was 0.6. No, Q2 is 0.6. So it's flat. Okay. As far as Eurozone wide, the GDP numbers has stayed constant. On the year-to-year, it actually dipped 5.4% for last year. So for the first quarter of last year compared to year on year, we can see that the GDP is obviously coming down to 3.9%. So this is about the worst they have ever seen since Q2 of last year. So on the last 4 quarters, this is possibly the worst quarter they have ever seen. So as far as quarter to quarter, it doesn't show the true impact, but on a year to year, you can see that Eurozone GDP is starting to slide back. Okay, so that again is a negative news. Over in Canada, you can see that the consumer price index, yes, come off a little bit, 6.2 to 6.1, largely on reduction in energy prices. We can see that crude oil prices have actually slide back to at one stage below $96, or no, $86. And of course, before the weekend come, it goes back up to $90 again. So we can see largely due to the energy bill becomes smaller, GDP has the CPI numbers in Canada has slide back. We also saw that in the States, in which it was at 9.1% in July, it came down to 8.5% for the month of July. Okay, June, July, sorry. So you can see it's a mirror image of what we see in the States, but over in Canada, it didn't dip as much as what we see in the States. Retail sales is also going down. Retail sales, they were expecting only an increase of 0.3, but it came in about a bit more robust at 1.1%. So that is a good number. Okay. Again, we are not seeing very much going forward. If inflation is going to rampage away sooner rather than later, consumers in Canada is going to start prioritizing their expenditure, what they want to spend on and what they can basically go without for a time being. Okay, so this is what we are seeing in Canada. In the state itself, this week we have retail sales. Now, retail sales is a big number. Okay, like I always mention, the US economy is made up of retail sales. 70% of retail sales is actually captured into the GDP numbers. Okay, so retail sales is a very, very, very important number for the United States, and it came in zero. There was no growth whatsoever compared to the month of June. So this is definitely going to be a negative for the United States. And existing home sales, that is a very minor number, but I want to bring up this number to show you what I think is going to be hiding a very serious situation here. Retail, okay, there are two kinds of home sales. One is called existing home sales. That means in the resale market, people buy existing home. Okay, so that number has been climbing, and over the last 6 months, it has dropped by such a speed. Okay, over the last 6 months alone, they have lost something like 1.7 billion less transaction for resales. It means people at the secondary market is not buying and selling as much as it was before the beginning of this year. So over the last 7 years period, this is important. Just before the 2008-2009 financial crisis, which was largely due to the subprime crisis, which is basically people with very poor credit score are able to buy properties, and they don't buy just one because the bank was just giving away loans for anybody, even with suspect credit rating, to buy properties. That caused the ramp up in property prices going into 2005. The US property market actually peaked in 2005 and only started to roll over in 2006 and actually collapsed in 2007. So even just before the market collapsed in 2000 and started to roll down and collapse in 2007, it took the market something like 8 to 9 months drop in existing home sales before the market collapses. So right now, what we are seeing in the existing home sales, the last 6 months in the beginning of this year, we can see that the rate in which the fall in existing home sales is so severe. It's even more severe to the prelude before the subprime crisis. So because this is a minor number, very little is being written or spoken about it. So, but I want to bring to your attention, you want to watch this, because if existing home sales is plummeting at a rate even faster than before the subprime crisis, that should raise a red flag. The other number that we want to see is new home sales, which is going to come out, I think, on Tuesday. So if the new home sales continue to have the same trajectory, I think we are just waiting for the inevitable thing to happen. Okay, so I'm not too I'm not too sure where this thing is heading. So this is where you can see existing home sales, there was no estimate. It is the worst we have seen since the beginning of the year. Resale market, nobody is buying as much as they used to be, because prices has escalated so high that existing people who wants to buy pre-owned houses are being priced out of the market. Okay, so that is a worrying sign, because at the end of last year, we are already seeing big financial companies like BlackRock. They are buying properties in bulk. Okay, because what they do is that they have been buying properties off the plan in bulk. Those who really wants to buy are priced out of the market. Okay, so right now America is going to be a nation of renters. Going forward, I don't think the Americans, especially those just coming out to work, can afford to buy any properties, because property prices have escalated to such a point. And now we have mortgage rate also increasing. So most people will not be able to afford their first home. Okay, so that will be a situation we want to watch. If the new home sales is also seeing the same trajectory, I think that is something we should be watching over. Okay, so month on month, you can see that the numbers are all coming down. Okay, it used to be in July of 2020, 4 months after WHO declared COVID-19 as a pandemic. You can see home sale prices started to escalate. Okay, even those in the existing homes, I mean second, not new homes, those they are already built and are in the market. There was this major spike up in demand for all kind of housing. Okay, so we have seen that slow down a lot since then. Okay, but because of this spike, okay, that means somebody already knew the inflation is coming and it's going to be very, very severe. Okay, so they start buying properties in bulk. Okay, so there we have it. Next week, this coming week, we have this various numbers coming in there, and they are all major numbers. We're going to be first starting off with China. We're going to see whether China is going to hike or reduce interest rate. Based on what they have done this week, okay, because of the retail sales from 5% came out only 2.7. China on the very same day actually cut interest rates. Okay, so very, very likely the People's Bank of China is not going to increase interest rate. There's a possibility they may even bring it down from the existing 3.7%. Okay, so this is going the opposite direction of where everybody is heading. Every central bank is hiking interest rate. China is trying to hold on to their economy. They know higher interest rates is going to defer the economic expansion. So they need to make it cheaper, because right now China is having a lot of issue, not only with the cross-trade issue with China, with the US and Taiwan. Within the Chinese economy, we knew from reports coming in that basically the real estate market has actually imploded. Okay, so they need to hold the line. Even the tech companies are not doing well. Okay, so right now we have this decoupling going on. We saw that this week, 5 Chinese companies in the state has actually delisted for the New York Stock Exchange. So we can see that the 2 biggest economies are going separate ways, and this is not good news for globalization. Okay, on Tuesday, we're going to see the PMI numbers. This will be a major number because Germany is a manufacturing powerhouse. So if the manufacturing PMI coming lower than expected, then we all know that Germany is in trouble. We already knew that Germany is in trouble because of the inability to get hold of reasonably priced energy products. Okay, now Russia is playing hardball with them by only supplying them about 20% of their regular supply of natural gas. And for the next 3 days, Russia is just going to switch off the pipeline because they say, look, I need to service those pipeline. And so basically, the whole of Western Europe is going to be in deep trouble going into winter. Okay, so this will eventually knock on the ability to manufacture anything, because Germany is the major manufacturing hub. If Germany economy starts to falter, it's going to spill over to the other economy. Okay, Germany is the engine that's behind the Eurozone. If the engine is not firing on all engines, that means the Eurozone will not be doing well. So they're only expecting us 48.1, which is already bad. Anything below 50 is considered to be bad. Now the previous was 49.3. So if this time they're expecting 48.1. If the number coming below 48.1, the market is just going to sell off. Okay, so do watch this one. And Eurozone, we also are expecting the composite PMI. Again, is a reduction number from 49.9 to 48.8. Again, if the number coming lower than these numbers, it's all going to be downhill. On Tuesday, beside the Eurozone, we also have UK. UK is also looking at services PMI. Now, UK, the services PMI is even more important than the manufacturing PMI, okay? Because the London is actually known for financial services. So service PMI is going to be key. They're expecting a reduction, although it is still above the 50 mark. The previous was 52.6. Now they're only expecting 52.0. Over in the States, we're going to see this number, the new home sales. Okay, if this number come in lower, much lower than the market expectation of 0.75, then of course it will be in sync with what we're seeing in the existing home sales. That will be key. Okay, so there is no consensus on the change. Okay, previously it was already negative 8.1. So if this number came in even worse than negative 8.1 or 8.9 or 8.10, then we know that we are seeing the same trajectory in existing home sales. Now we have seen the same thing in the new home sales. So this could be, again, this is a very minor number. Most traders do not even look at this number, but because I have highlighted the fact that the rate in which the existing home sale has plummeted, okay, over the last 6 months, so sharper than before the subprime crisis, then I suppose it is worth taking note. Okay, durable goods, okay, is also a major number for the States. Durable goods means goods that they have longer lifespan. Okay, for example, refrigerator, automobiles. These are not those things that you buy and then if it doesn't work, you throw them away. These are basically durable goods in which we'll see how demand is picking. Typically, in a recession, durable goods is something that you can defer buying. Okay, if it's not really spoiled, you just make do with them first, because your priority now would have to be put food on the table. So durable goods is a reflection of how robust the economy is. If economy is doing well, you may not have to prioritize your spending. Maybe you just go ahead and buy that 60-inch television that you have been eyeing for so long. So, but in a recessionary situation, the 60-inch television is not a must buy. It's something that you wish you have, but it's not necessarily something that you need to get right now. You can do it at some point in time when the economy gets better, or at least the incomes, started to stabilize and goes up. So that one will be something we want to watch. Is 0.6% compared to 1.9% previously. The non-defense capital goods is very similar. This one refers to companies, okay, other than aircraft, because aircraft is a very volatile piece. Anything that's non-defense related, if this number increases, it shows that companies are prepared to invest in either expanding their factories or retool their factory, for a new range of products they want to build and sell. Okay, so again, this is a key number. They're only expecting 0.2% compared to previous of 0.5%. Then on Thursday, we have retail sales for New Zealand. Again, they also expect a reduction of 0.6 from previous 1.9. Sorry, retail sales is no estimate. Previous was 0.5%. GDP for US coming in on Thursday itself, they expect a notch down of 0.8% compared to 0.9. So going into this weekend, starting from Thursday, okay, the US have their annual thing called the Jackson Hole Symposium. This symposium is held every year, okay, at Utah. okay, at this place called Jackson Hole. So basically what they'll do is that it is basically getting all the major policymakers, journalists, economists, central bankers from around the world. They all come together and they will basically discuss about where the global economy is heading. So it will stretch over to Saturday, okay, to over the weekend. So it will be something that will impact the market going forward, and that happens to be in the last weekend of August. Watch out for the communique that come out from this particular symposium. It could be market moving. Okay, so there you have it. What has happened this week and what may happen in the coming week. Now let's take a look at what the market has been doing this week for equity markets around the world. Here you have a snapshot of what the market has been doing, basically from the States to Europe to Asia. Okay, you can see Dow Jones is down marginally at 0.16%. So it does not seem like a lot, but if you look at the chart, the market is having a reversal signal, at least in the daily time frame. So do watch out of all these equity index. S&P 500 comes down a lot more at 1.21%. At 4,228.48. The Nasdaq Composite came down the most at 2.62% at 12,700. So you can see that the US equity index is beginning to react, because after going up redundantly for 6 weeks in a row, we can see that finally they are taking a break. So it could be a temporary pullback before it goes up again, or it could mean something more. Okay. Over in Europe, we can see the FTSE 100, which is the UK index, is the only one that managed to register a plus going towards the weekend. It's up 0.66%, closing at 7,550. DAX, which is the German equity index, is down 1.82. So if you look at DAX, it's not doing too well. Okay, if it basically reflects what we are seeing in the Germany economy, whether it is going to be made worse by the coming manufacturing PMI that we're going to expect on Tuesday, we will have to watch. Nikkei is also pulled back at 1.34, but before going on to this week itself, Nikkei has been doing relatively well. Okay, surprisingly, has been doing relatively well, but by the end of this week, it was down 1.34%. Hang Seng obviously is not doing well throughout the entire week. It's again back down below 20,000, which this 20,000 becomes a level in which it has crisscrossed so many times. It has no longer bear any significance. Okay, but it went down and closed at 19,773 for down 2%. Shanghai was struggling. Shanghai is trying to go up, but again, it was pulled back down, losing 0.57%. The Bursa also managed to hold pretty well. It was only lost 0.12%. If you look at across the board, it is the least pullback among all the equity index that we have that I'm monitoring. It's down at 1,504. So let's go through them one by one. I will start with the weekly time frame. So this is the Dow Jones weekly time frame. This is the cash index. You can see that the market has pulled back. Notice how this bar looks like. This is a classic reversal bar as far as candlestick is concerned. The market traded to a high of 34,281.36, closed back down. This is what is typically called a very classic reversal signal. All I need for this market to go to tell me that it's going down is to take out the low for this week. Okay, you can see the market closed at 33,706.75. It's not very far from the low of the week. Okay, so all I need to do is market take out the low for this week, and it will basically confirm that the market is going to go down. Any rebound thereafter is calling to be sold. Okay, so this is the daily time frame. The market only comes off on Friday. It actually on Tuesday, the market went up into a high since the low we saw in June. June low was 29,653, and on Tuesday this week, the market actually went up to a high, the highest it had been since the low in June at 34,281. So you can see the market actually held very well. There was a couple of this. There is a inside bar of this Tuesday's price action, and then on Thursday there was an inside bar of the Wednesday price action. So we have an inside bar of an inside bar, and the market is not sure which way to go. if the market have taken up the high of 34,281, it will continue to chart higher because this is a cluster of the market trying to decide which way it's going to go. Okay. Then on Friday, you can see the market actually took out this very near-term support line. Okay, of course, this line is drawn by me. It doesn't exist anywhere in the actual market. Okay, but by looking at the chart itself, it has cleanly broken out of this support line, coupled with the fact that the market is coming off from a very overbought situation. Going into this way, I've been telling myself, okay, maybe the market may continue to extend, but because it is already overbought, technically the market is vulnerable. It doesn't take a lot of reason for the market to flip, okay? And this week, we don't have a lot of things that actually can cause market to actually come off, but it did come off on Friday, okay? And you can see that the RSI from an overbought situation is beginning to come back. If it goes all the way down and go below 50, then we are likely to see something even more severe. The bottom for this move here, the key level to watch will be 32,387, okay? So if this level managed to hold, there is still that possibility that the market can still go up and take out 34,281. But for now, the market is likely to come down. Going into the first 24 hours, that is tomorrow, I think market will continue to go further down, okay? So this is the Dow Jones. S&P 500, we are seeing the same thing. We don't have a classical reversal seen in the S&P 500 weekly time frame. The high trader was 4,325, and so far the market has come down in 3 waves. The rebound is also 3 waves, but this 3 waves looks a bit extended, looks more like a 3rd wave of a potential 5 wave. If this is the case, then there is possibly another move after this pullback and go up to 4,325. Okay, but it's still very, very preliminary. Okay, for the week itself, it's only down 1.21. It's not very, very much. So this is the daily time frame. I forgot to draw that support line, but you can see that it has also clearly broken out of this line. So the high trader managed to take out this high, which I thought was pivotal. Okay, it was at 4,308. Market did actually go above, but did not quite close above this 4,308. It has registered a marginal high at 4,325 and closed just under below 4,308, and that could be technically informative because there was no desire to close above this line here. And again, we have an inside bar of Wednesday before the market actually comes down on Friday and close near the low of Friday. So this is also very similar to what we have seen in Dow Jones. Market came from a technically overbought position coming down. So anything above this price is actually, it needs a lot for the market to actually push even higher. In the absence of any compelling news, the market does not have the reason to go higher. So it decided that it want to come back down. So this pullback could be a technical pullback before it goes back up again. But we will have to see if this market RSI is trading below 50, then it could point to the fact that the market has possibly peaked and is getting ready to resume its larger downtrend. Okay, the larger picture is down. I can see that the largest square I have here is pink in color. These smaller green boxes are the counter trend to the downtrend. Okay, but I've also don't like the way that it goes up because it is this extended run from 3,721 to 4,325 looks very much like a 3rd wave to me. Okay, so if this is a 3rd wave, it means the market may actually pull back. This level of 4,079 may actually hold before the market attempt another move higher to above 4,325. So long as 4,637.3 is not taken out, the entire player is still calling for lower prices. Okay, but if it's a 5-wave move, okay, it could be part of a 3-wave corrective pattern. Okay, a 3-wave ABC move typically have 3 waves. Okay, but within the 3 waves, sometimes they also have very neat 5-way structures, the subwave itself. So we have to watch. Okay, ideally I do not want to see a 5-wave. Okay, because if it's a 5-wave, it complicated my count. Okay, but it is possible. The Nasdaq 100 has quite similar structure. Okay, the overall market sentiment is up. Unlike the S&P that has already peaked, remember just now I showed you most of the boxes are pink in color. The rebound is actually green. This one, the underlying trend is still very much bullish. Okay, the market came very, very close to take out to actually flip into a bear trend. Okay, but it came close enough, but wasn't close. It was at 11,037, which we need the market to go below 10,000. I think it's 677.85. Came pretty close before it rebound. So this rebound is still on the weekly time frame, not conclusive. I cannot see a reversal signal on the weekly time frame, unlike what I saw in the Dow Jones. Okay, so I still have to basically eyeball this trade. Now the Nasdaq 100 on the daily time frame, this is a very neat come off. Okay, the market actually registered a similar high like the S&P 500 at 13,720 on Tuesday. Couldn't quite maintain it, and then on Thursday itself, it was an inside bar to the Wednesday price action before it comes back down. Now, in terms of being overbought, yes, it was overbought, but it wasn't as severely overbought as compared to the Dow Jones or the S&P 500, but it is coming down, okay? So this coming down, the crucial level in which I want to see taken up will be 12,945. If this level can be taken up cleanly and close below, then I got more confident to call that the market has actually peaked at 13,720, okay? So I would love to see that move. But until then, the overall trend in the daily time frame is down. Okay, so the daily time frame at least is telling me the market managed to go higher. It is still calling for a short unless 15,265.42 is taken out. Okay. Over in the UK itself, we can see that despite the bad news coming in where inflation is at 10.1%, the UK equity market continue to charge higher. Okay, this is coming very, very close to that crucial level of 7,700. So yeah, 7,689 was a high traded at the beginning of 2020. And then it did try to attempt to go back up to those levels again at the beginning of this year. Okay, it did not quite make it. The highest it ever did this year was 7,687.27, just marginally below this high here, which I need the market to close beyond. It did not quite make it. It comes back down and then push back up. Now this week it went up again to 7,578. Is it going to be this time the market is going to take out? The fundamentals do not support this scenario. Okay. I cannot explain how equity markets in the UK is as firm as it is. Okay, it has been like this for quite some time. Earlier on in the at the beginning of the year, this move here, I was actually selling. Okay, but this pullback was a lot sharper than I anticipated. Okay, so subsequent shorts did not quite do as well. So I have stopped monitoring, or I've stopped engaging this market because I want to see how this thing is going to resolve and tie in with the weak fundamental that we are seeing, because the price itself is not showing that it is very weak. In fact, it's telling us it should be a market that we should be buying. So I do not know how to interpret this, so I'm just going to put it aside and just watch. Okay, in the daily time frame, you can see that it is still very much a bear trend. In this case, in the daily time frame, the level in which I need to see is not 7,687, it's 7,646.66. If the market can close above this level, then yes, the market is likely to chart even higher. Fundamental, regardless, the market based on price is telling us that it wants to go higher, so we will have to watch. But again, when as the market comes closer to 7,006, we can see the RSI is edging towards the overbought zone. So this is definitely not a market I want to chase. Okay. In fact, if the market is at this kind of level, one more attempt at 7,006 cannot be taken out. The market is going to unravel. Okay. Though this could be setting up to be a short position with very, very low risk. Okay. Anything above 7,578 to 7,646, that is my risk. If the market goes above this price level this week, which is this week high, okay, I will see if I can find the lower time frame, the 160 minutes. If there's a reversal at the lower time frame, I will take my chance to sell this thing and put my stop just above the cash equivalent of 7,646.66. Because if I'm wrong, then I will take this small loss. But if I'm right, everything at the bottom is for the taking. Okay, so this could be ending up to be a great trading opportunity. Over the index, of course, this market has not been doing too well for some time, but it is still very much in the bullish phase. The market has turned bullish from the low of March 2020 at the start of the pandemic, and it continued to rally all the way to 16,285. Of course, since the start of the Ukraine war, this thing has not been able to revisit higher prices. You can see this high here actually coincides very well 2 months before the war in Ukraine broke out. But ever since, you can see market has taken a very sharp drop, okay? And then there was obviously a rebound. Now the market is come back down again. So this bar here is, I would have loved this bar to be a bit longer than last week low, but it did not, okay? Because if that is the case, then we have a very bearish setup, meaning to say we have an outside bar, but this bar is not an outside bar, okay? So we don't see, at least not in the weekly time frame, okay? But this market is obviously based on fundamental. It's a market in which is screaming to be short. Over at the daily time frame, you can see that there is no reversal signal, at least not in the what am I showing you UK? Okay, maybe I given you a wrong chart. This is the wrong chart. This is the UK chart. So sorry. Okay, let's see next one. Okay, over in the Hang Seng. Hang Seng, this is the daily weekly time frame. Hang Seng has not been doing well. It has been in a cloud ever since. The market has been falling for ages already, okay? So the high traded back in 2021 was 31,183. This year, the high traded was definitely below 26,000, okay? So the market has been going down, but there was a rebound in April, which to date it has not been taken up this new high. So the market has been losing steam again. So overall, this market is higher to sell, okay, basically. Over the daily time frame, we can see that this pattern that we are seeing is a very neat three wave. The market has gone up without a neat three wave. I mean, there's a three wave rebound. Okay, so far this wave pullback here is slightly to gun for 19,178. Okay, which is the low traded back in May. Okay, so this market is definitely sliding lower and lower. And if the market take out 18,235, the market is going to go all the way down. Okay, so this market is pretty weak right now. Over in Shanghai, on the weekly time frame, overall, you can see the pattern is calling for this market to be relatively stable. It is not as weak as the Hang Seng Index because you see the box here is actually green, but the larger box is actually pink color. So you can see that this is actually a rebound of a very major bear trend. The Shanghai market actually peaks in 2007. It has not seen back those highs for a long time. Okay, so you can see that there's this rebound in late April all the way to 3,424, but it's losing steam. Okay, so if the market take out 3,155 this week, the market is going to go back down again. Okay, overall I think this is going to be a three wave move, a larger three wave move. Okay, so again Shanghai is higher to sell. This is the daily time frame for the Shanghai market. Has taken out a intermediate resistance line, but it couldn't take up 3,308. Okay, this is the barrier of the barrier to higher prices, which I think if you're monitoring the Shanghai Composite Index, this will be a level in which to watch. Okay, so far the high that it managed was this week, was on Wednesday at 3,295, and then the market has been coming down since. And if the market goes below 3,155 again, then of course this resistance line will have to be removed because it serves no purpose for time being. But for now, it still can be used as a resistance turn support line. So for all we know, it can hold above this line for the next push higher. So nothing exciting to watch over at the Shanghai Composite Index. They are not trading at an extreme level. Over the Nikkei, like I said, the Nikkei has been doing relatively well. Okay, on a week-to-week basis, it's actually up 0.48 in the same company as the FTSE 100. The market has actually gone up to just under 29, just above 29,222. Okay, so this it actually closed on a higher note because it did not manage to capture the decline on Wall Street on Friday night. So maybe it will react tomorrow morning by opening low. Okay, so do watch out for this move. Overall, the market is pretty bullish, or at least in the weekly time frame. Over in the daily time frame, the picture is very different. Over in the daily time frame, the market is actually bearish. We are going to this area in which, very similar to the FTSE 100, the risk to reward is becoming to look very attractive because my key level here is 29,960. As a market chuck higher, even if it challenges the 29,388, so long as it doesn't close above it, okay, I think that will present a selling opportunity. If that is the case on a daily basis, if on any day this coming week, the market managed to go above 29,388, but on the 1 hour time frame, if I see a reversal on and the particular time frame, I will take my chance to go and sell it, put my stop just above the 29,960. And if I'm right, everything below, at least up to this support line, is going to be my potential. If I'm wrong, I just have to take a very small loss on a relative basis because the market is just coming up from an overbought zone. So whether or not you will go up again is anybody's guess, but my guess is that possibly the 29,222 this week is possibly the high this run. Okay. Over at Bursa, for those who are trading the Malaysian index, because I know among you guys, there are a lot of Malaysians. I'm sure you'll be very anxious to know where the local market is heading. It is even worse than the Dow Jones, okay? The high traded this week was 1,527.84, but look at how it ended. This is a classical, more bearish signal than the one that we saw in the Dow Jones, okay? Because it is in the red color. So all I need to do is to watch for a price that is just marginally lower than last week low. That will give me the conviction that this market is likely to go down and up. Okay, so anything that rebound thereafter is going to be calling for a short, and then this will be even lower risk because the high traded this week is going to be the determinant where you put a stop. Okay, maybe let's go down to the daily time frame. Daily time frame, you can see that there was already a reversal very similar to what we saw on the weekly time frame on Wednesday. When on Wednesday market traded a high of 1,527, it ended like this. This is a classic reversal signal, and on Thursday it has it actually took out the Wednesday low. That to me is a sell signal. Okay, so you can see the market actually managed to rebound a little bit. That rebound is actually the best selling opportunity this week, because if I manage to, or anybody who managed to sell this, typically what I do is I'll just put my buy stop just above this high here, okay, and then I'll take my chances. If the market goes back up above 1,527.84, I cut loss. But if I'm right, then Friday this move here will be like, you know, expected. Okay, again, the market is on an elevated zone. The market was already diverging for more than 2 weeks. You see this high here, it corresponds with this high somewhere here, okay? As market goes up higher and higher and higher, you can see the indicator did not quite follow, and this is a typical divergence. When the market is healthy, the indicator should be showing the same thing that what we see in the price action. But in this case, on the daily time frame, we can see that the market was not showing the same thing that we see in prices. In fact, it is already diverging. So this move followed by a reversal pattern like this is a classical sell. Okay, how low it will go, we do not know, but all I know is based on individual candlestick pattern followed by this. Okay, we can say that the market was actually setting up to come down. So going forward, this coming week, I think we're going to see much lower prices for the KLCI. Now we are finished with equity index. Now we'll be talking about the foreign exchange. And I'm not going to cover everything in the foreign unless you guys has a pair that you guys are interested. And if you have, put them all into the chat box so that I can prepare for you the next Sunday. Now, before we go into FX, is there any other question that you want to ask me up to this point? Because I do not want to go into a Q&A at the very end of this presentation. They ask me, oh, what's my view on equity index? But then, you know, we are so far away from the topic. I want to address your concern right now and your question on equity index before we go on to the next segment. Anybody has any question that you want to ask me as in regards to equity index? If you have, you can type your question into the chat box, or if you like to talk to us, unmute yourself and post your question. Anybody? 1, 2, 3, no? Okay, then we move on. Now, for FX itself, again, we are seeing a bit of a movements as far as the dollar is concerned. The dollar this week has been going back up again, which is its original trend. We have seen the dollar pull back for quite some time. I think the market has a very high possibility that it has already finished its corrective pullback and is getting ready to go back up again. Because why? Because this month there was no FOMC, so there was no risk that the Federal Reserve will high interest rate. So this month the market pulls back. It's very normal. But going to September, we're going to have FOMC meeting all over again. That FOMC meeting will be on September 13th. Okay, it will be in the middle of the month. So again, there will be expectation based on what we see in the job numbers. Very robust. That means it gives the Federal Reserve a lot more leeway to high interest rates. And then we look at CPI. CPI come down. So again, that is, market has a different way to look at it. If we have a very healthy job market, because we haven't seen a lot of layoff yet. In fact, the unemployment rate has been improving marginally. Okay, then we see CPI numbers has come down from the peak of 9.1% in June. Now it's coming down to 8.5. So these two data in combination, we will have to think what the Federal Reserve are going to do, knowing that job numbers is supporting higher rates because now they have the room to move to hike even more aggressively without having to worry the economy is going to flip into a recession because job numbers are good. Okay, then we have CPI coming down. Do they mean that they have to redouble their effort to bring down this number even further? Maybe they concluded that because of the rate hike, yes, inflation has come back down. So now if they increase even further, hopefully the inflation numbers can come down a bit more compared to what we have seen 8.5% for the month of July. So the market is not sure which way the Federal Reserve is going to react. But because of these two set of numbers that come in rosier than expected, now there is this narrative that the traditional media has been telling us likely to end up with a soft landing, meaning to say if there's going to be a recession, it will not be severe. So this is a very dangerous way to think. Because the way I see it is if people are beginning to be more complacent about the danger that lurks ahead, and started to think that the worst is over and from here onwards it's all going to get better, they're going to be in for a surprise if the numbers started to pick up again. Okay, so I don't like it when the whole world is complacent. Okay, because they need to keep their eyes on the ball without losing track on what is really happening. Okay, so that could be something that we all want to watch. We want to take a contrarian view to what the traditional wisdom is telling us. Okay, at least the traditional media has been putting up an analysis and commentary saying that the soft landing is possible right now. And this is, to me, very, very dangerous. So as far as FX is concerned, the dollar is coming back up because going into September, again, we're going to face with the possibility of another massive rate hike again. Maybe not as high as 0.75, but 0.5 is a given. Okay, is 0.5 a good number or a bad number? We will have to see. So as far as euro is concerned, euro continued to slide, but for this week itself, it actually managed to rebound back to above $1. Okay, sterling obviously is suffering under the weight of a very severe inflation number of 10.1%. Okay, so now the question is the Bank of England going to hike rates again? And if that's the case, then sterling should actually go up. Why is it coming back down? In fact, it came down by almost as severe as the Japanese yen. Okay, because if the central bank hike interest rates, that currency should actually goes up. Now at 10.1%, the Bank of England will have no choice but to continue the high interest rate. But why is sterling coming down? So that is the million-dollar question. Dollar yen, obviously, we need not to say dollar yen has been going up since the beginning of April. So the market has been on a one-sided move all the way to 139 this year. Okay, so it has pulled back a little bit to 131. Now the market is going back up again. Now close just under 137 for this week, up 2.6%. So that is just continuation of an existing bull market. When you look at a chart for dollar ringgit. Okay, why I put the Malaysian ringgit here? Because I think there are, like I say, some Malaysians here who are concerned as to the well-being of their economy. So I've decided to put in not only the KLCI, I also want to put in the dollar versus the ringgit. Ringgit again got up to new high for this year. Okay. It got up by now it's currently doing at 4.4765, which is relatively high. So let's go ahead and take a look at the chart itself. This is the weekly time frame for the euro versus the dollar. You can see that on a close-to-close basis, this is the lowest it has ever gone since 2019. Okay, the market went down below $1. Okay, in late June. Okay, then it managed to rebound. Now this week it closes like this, and technically it's a very, very poor performance, suggesting prices is just going to go down, down, and down. Okay, so we want to see on a day, on a year basis, it's already down 11%, which is quite severe for a currency. So you can see this trajectory is just going down. There's no green color box. Now this green shaded area is actually my target. It's not showing that the market is in a bull market. These are my target area to buy back. Okay, that means that I do expect market to continue to slide all the way to 0.85, 0.885 at least, at the bare minimum. Okay, so this is a long-term bear trend. I have always maintained the idea that euro as a currency is going to fail big time. It's simply, it has, in my opinion, a good candidate to disappear altogether. Okay, many will say that in Europe, most of them are likely to go back to their individual currency before the common currency. Many will say that the German will go back to German mark, Italian will go back to the lira, the French will go back to the francs. Okay, so basically, I think we are seeing this in the currency itself. In the daily time frame, you can see that the market has taken out a major support line. It has been holding out this line very, very well. At the beginning of the week, it took it up. Okay, it hesitated for 2 days before it decided to come back down again. So you can see this week itself, it started on the wrong footing. It came down from a high of 1.0369 all the way to close just above the parity mark of 1. Okay, going forward, I think the 0.9952 will be taken out. Okay, easily will be taken out. And as the market slides lower, once it goes into oversold situation like this, then we will maybe want to buy back for the, a potential rebound. Okay, so but any rebound is screaming to be sold. This market is long-term bearish. Right, this is the sterling. Sterling also have a bad week this week. But going into this week itself, you can see last week there was an inside bar. The market did not quite take out the previous week high, neither did it take out the previous week low. There was an indecision on the part of sterling, but this week it was resolutely on the downside. The market actually closed on a close-to-close basis, the weakest you have seen since the pandemic started. Okay, of course the pandemic started here. Okay, at the low here, 1.1410. Okay, so we are heading towards this level and possibly below. My target is below parity. Over the long term, I do see sterling going below $1. Very far from where it need to be, because I remember as a kid, sterling versus Sing dollars was $3 to 1. Now it's only half. So the sterling has come a long, long way. Okay, so over the longer period, I think sterling will also go into more difficulties. Sterling on the daily time frame is already approaching this 1.1760, very, very close. The odds of it taking out this level is very, very high. My immediate target for this move is 1.1469, 1.1450. So this horizontal red line here is my immediate target. So if the market continues to slide, and if it slides to those levels here at 1.140, 1.14 half, where the indicator will be in the oversold zone, then maybe it's time to take some profit and then waiting for the technical rebound to happen. Okay, the market do not necessarily go down in a 90 degrees fashion. It will go down, you know, step by step by step. Okay, but along the way, once it goes into oversold, then if you already sold it, then maybe you want to take a view of taking some profit off the table, waiting for the rebound to happen, and then look for levels to reposition the short. Okay, never buy this pair of currency. Okay, long term, this market is going down. Dollar versus the yen has been going up for quite some time already. At the low of 2021, this market has spiked all the way to 139. Yes, from 139, it went out to 130.39. That was a pullback. But so far, this pullback is not necessarily over. Okay, on the weekly time frame, we don't have a 3-wave pullback. Okay, we only have one wave, two wave. So there's missing one leg. Ideally, we want to see this market pull back down again. Okay, so but if this market continue to go higher and take out 139.39, then of course this is not going to happen. Okay, the market just going to go and extend its original bull run. Okay, so on the weekly time frame, I do want to see a more complete three-wave pullback, meaning to say that I ideally want to see a decline below 130.39, ideally to around 126. That will be very perfect, because this level at 126 is actually where the low was in early May. Okay, if this is the case, this will be what we call AB equal to CD move, the most perfect setup, waiting to buy here for the next push higher. Okay, on the daily time frame, we do see a three-wave pullback. Okay, there's a three-wave pullback here, and followed by a three-wave extension to the upside. So it can still come down. Okay, basically this is what I'm saying. Okay, so the key here will be 137.46. Going into the new week, if the market goes above 137.46, then of course I have to eliminate this pink color box and assume the market will take up 139.39. And if 139.39 is taken out, then of course the pullback from here to 130.39 is over, and the market is resuming its uptrend. Okay, so we will have to watch this move. I do not want to buy here. Ideally, I want to see the market pull back down below 130.39 to at least challenge 126.36. That will be a key level for me to actually position a long-term position to buy. Okay, if the market can come down to this level, I want to keep a long-term position on the buy side of dollar. Okay, but if the market takes out 139.39, of course this would have to be abandoned. Do I want to chase? No, thank you very much. I don't want to chase because it is outside my comfort zone. It must be within this green color box. Anything outside is very dangerous for me. Okay, so on the dollar versus the ringgit, you can see that the market this week has a tremendous blowout move to 4.478. So this is about the weakest we can see since 2020. Yeah. Okay. Even at the peak of the pandemic, the ringgit has not been this weak. So now we can see 4.478 is about the weakest. So will the ringgit continue to weaken? I think yes. Technically, there's nothing to suggest that it will come back down. Okay, or at least the dollar versus the ringgit will come back down. What I'm saying is that because the dollar goes up, it means conversely the ringgit is going down. Okay, on the daily time frame, we can see that this move here has been extending for quite some time. And if you think that the market is just going to run away, you may be comforted by the idea that this thing is diverging. Okay, we have higher high and higher high. Indicators has not matched this move. Okay, so at any one time, what we can do is join this bottom here, draw a support line. Okay, anytime you see a reversal signal and the candlestick on the daily time frame, that could be telling us the market is about to peak and maybe pull back on a technical basis, because we are seeing the market diverging so much. Okay, this divergence is telling us that this market here, as it goes higher and higher, is not very well supported technically. Okay, so that could be the saving grace for the ringgit as far as I can see. Yeah. All right, before we go on to precious metal, anything that you want to ask me regarding the currency markets? No? Okay, in this case, we move on to currencies, and we are moving on to precious metals. And I'm going to concentrate on the futures market. I'm talking about COMEX, gold and silver, because like I mentioned all this while, between the spot market and the futures market is the one that actually leads the market, because when we trade in the before New York comes into play at 8:30, the market is basically just moving along. The real move always happens at night. Okay, so it's good for those who are trading precious metals to be very aware of the COMEX, gold and silver markets. This week they are all down. Okay, gold is down 1,760 and down 3.2%. Silver is down to just under $19, down a massive 9%. I was selling gold and I bought back. I bought back I think on Thursday. Okay, so basically I did not catch the entire move. I decided to take my profit at the 50% mark. Later on I will show you. So on the COMEX itself, you can see that this is the weekly time frame. This is a continuous chart, meaning to say that I combine all the active front month and make them into a continuous chart so I can see the overall pattern. This week has been quite serious. The market has been going up for 4 weeks in a row. From 1678.4 go up to 1824.6. This move here has been very persistent for 4 weeks in a row. But this week, without taking out last week high, it started to unravel. Okay, so we can see that the market is for time being coming back down. But be careful with this move. The market is not about to collapse. What I'm saying here is that gold market is basically very, very firm. You can see the bigger boxes are all in green. So this is a market is still a buy. Okay, I don't consider this move here is telling us the market is going to sell off all the way below 1,450. I don't see that happening. Okay, so I do see a very firm price here of 1,666. This level has not been violated since it started in 2020. The last time it came close was 1,673.3. That was in March of 2021. Okay, and then again this year we saw another attempt at 1,678.4. It didn't quite break the 1,666. So on the futures contract, this level to me is key. Every time it comes close to this level, the market actually rebounded. There was another leg here. This leg is even stronger. This is a classic reversal signal. Okay. So we can see that the market is coming back down, but I am not bearish. I am looking for opportunity to go back in to buy gold and silver. Okay. So on the daily time frame, yes, the market took out a key low here. In fact, this is the level in which I buy back my position because I think this level may actually hold, but it did not quite hold. Thursday, it managed to challenge it, but without closing below this. Okay, but Friday, after I square my position, market decided to go under. Okay, so you can't take it, you can't make all of them. Okay, I started selling gold somewhere before the market, somewhere. Or just after the market peaks, okay, and the market has been coming down, okay. So we can see that this move here, the larger green color is going to be my basis, okay. On the daily time frame, this level is very close to 1,666, but this is referring to the December contract, okay. So December contract may have a different low. So this low to me is 1,676.9 or rather 1,678. Okay, so I want to see how the market if it started to drift lower and lower, if it gets into an oversold zone, and then if I see some kind of reversal signal like this is an outside bar. You can see this two color bar, the red and the green. So you can see this green color bar was so massive it actually overshadowed the high and low of the previous bar. So this is a very powerful reversal signal. In this case, this is a bullish signal. Okay, so we want to see this somewhere as a market drift lower and lower. Okay, so I think going forward, gold prices is likely to drift lower. Okay, but I'm not going to sell this thing. I'm just looking for the market to stabilize somewhere, ideally in the oversold zone with a buy signal. Then is where is my signal to go back in on the long side. On the silver has come down on the percentage terms even more severe than gold. Like I said earlier on, the market came down almost 9% for this week itself. So the market tested a high. This week itself, the market actually have a new high, okay, for this series of prices at $20.87, but it couldn't sustain and then came back down and give me a what we call a bearish outside bar. This is a bearish outside bar because we have a marginal high compared to last week high. So this is actually a very bearish development. So maybe the price of silver may continue to go down and challenge $14.56. Again, until this level is taken up, I am going to maintain a bullish outlook for even silver. Okay. This is the daily time frame. You can see the market overall is bearish. The bigger box is pink in color. These are target zone. This is not any kind of these are my target zone. If the market take out $18 and 1.185, the market is going to go all the way down. Okay, and if the market goes down into this oversold zone, I'm again on the lookout for potential buy signal. Based on what I see in the weekly time frame, I still have faith in silver. So we want to see how this thing going to pan out. It could be a very low risk trade on a relative basis. Now, any question on precious metal before we move to the last bit of the commodity market before we end up with cryptocurrencies? Anybody? None? Okay, then let's talk about the crude oil itself. Crude oil may have actually bottomed out, okay? Because as I was giving my talks in East Malaysia the topic of my talks for the last 3 presentations was crude oil. So I was watching the crude oil prices. In fact, during my first day in Kota Kinabalu, I was telling them the market is heading towards a very critical level, and AB equal to CD situation, which I think anything below $86 looks very attractive to buy. And lo and behold, that was the low, and the market started to rebound. Of course, anything going forward, market could revisit the low again, but I think based on chart point, I think that AB equal to CD move was actually a good call. Okay, let's continue to see. Now, this is the COMEX October, not COMEX, this is the NYMEX, which is the New York Mercantile Exchange, WTI, which is the West Texas Intermediate Crude Oil. So when you trade crude oil futures, why am I showing you the crude oil futures? Because this is the benchmark, okay? There are 2 benchmark crude oil products in the market. One is the Brent oil, the other one is WTI, okay? Brent oil obviously refers to the North Sea oil, and they all have very different chemical composition and properties. So, but they are standard barrier in the oil market. So most of the time when you read about news for energy, these are 2 grades of oil in which most analysts will be basing their report on. Okay, so for WTI, this is a key benchmark product. Market is very, very strong in the what you call that, a bullish market. Of course, this is an aberration at a high just 1 month after the WHO announced COVID-19 as pandemic. The market went into a tailspin because we have seen the sharpest collapse in equity prices, and there was that period of time whereby the global economy went into a recession, or at least on the fear of a recession, because we need 2 quarters of negative number to actually classify as recession. That was only 1 month, okay? The month itself, the market went down so fast, okay, because of the lockdown on borders. Suddenly, there was this talk about there's not going to be enough demand, okay, for oil, and oil was just selling off. And then, of course, this is an aberration because it's impossible for prices to go into negative, but for trading purposes, this is the first time I've actually seen crude oil in negative territory. Okay, for a lot of people, this is the first time that this thing has ever happened, and it will never happen again. Okay, so from this low of negative $40, market went up all the way to $100.50, and the market has been pulling back. This pullback is very neat 3-wave. What I'm saying here is if this is a 3-wave move, okay, A, B, C, D. If you take the entire move of $130.50 to the low of B, and then you extrapolate from this high of $123.68, you get exactly just under $86. And the market actually reversed. Now, this is a very a tentative reversal signal. This is a classic, but it's in the wrong color. I would have preferred it to be green color, but it's red. Okay, but color aside, I think it is still calling for a low here. Okay, so going forward, I am not surprised, despite what we have heard that energy prices are coming down. Yes, it came down since late April. Okay, no, since March. In the weeks that following the Ukraine war, the market actually went up to $130.50, but it has since pulled back. The last rally attempt was 126.38, did not quite make it come back down. Again, that was a very bearish development. This is the outside bar. Okay, market continuing to go down for 2 months in a row. Now we see this. This is a very tentative, very small reversal signal compared to what we see here. This is a huge, okay, but this is tentative. It could still come down, okay, but what I'm saying that now we have at least a AB equal to CD situation, which I think stands a very good chance of taking a buy position, putting the stock below $85.73. So we can see that the low traded was what on Tuesday. Tuesday is where the low was, okay, and the market has been going up to as high as $91.69. It couldn't maintain, but still close on a positive note, okay. Still close on a positive note. So basically, this is how we see the prices going. This move here, this entire leg here, if you extrapolate from this high here, is equal at $86.11. $86.11 was my target. The market went up just marginally and then stabilized and then started to go up. Because the day after the market took out the $86.11, it went into a inside bar. And during an inside bar, all I need to do is for subsequent days for the market to take out the high of this particular bar. And it did on Thursday. So Thursday, it actually give me the confirmation. So anything lower after this, if the market do pulls back, and it did pull back, you can see this market has a low intraday here. So that was a buy signal technically, okay? But I wasn't able to do this trade because I was traveling so much. I was moving from city to city on a back-to-back basis, and most of the talks are in the evening. So by the time I get back to my hotel, it will be a plus 10 o'clock, and I'll be so tired. So most of the market move this week, actually, I didn't manage to catch, okay, except for crypto, okay? Crypto, I was holding on to some position. So you can see market has been, to me, there is this very high likelihood that the market actually bottoms out, okay? Although we did not see a very classic reversal signal on the daily time frame, unlike what we see on the weekly time frame, it is still a very good call, because if I'm wrong, anything from here, the market closed at this is the October, this is the September contract. You shouldn't be trading September, because September it's going to expire, has already expired, because the option market closes on the 19th. Today is the 20th, 21st. So do not trade the September, trade the October instead. So based on October pricing, we have $90.44. Okay. Anything below here, if you go in to buy, put a stop below $85.71, it's a good trade, because if you're wrong, this is all you lose. If you're right, the market, especially when you draw this very simple resistance line, if you take it up, and it could all the way go back to 123.68 for all I know. Okay, over the medium term. So natural gas, again, this is a September contract. Natural gas has been doing very, very well indeed. Okay, it has already challenged this year's high at $9.75. Okay, you can see that last month, okay, this time last month, middle of July, you can see market actually went up to $9.752, and then it came back down. Then followed by this bar. This bar was last week bar. This is a bullish reversal. Okay, this is an outside bar. This one, of course, is a very bearish development, but it did not cause the market to go all the way down. So the market actually stabilized and started the reverse position last week, and this week extended, but it has to go above $9.664 for me to actually convincingly say that the market has resumed its uprun. Okay, and all points to higher prices, because like I said, we are not that far away from the winter, and this year winter is going to be very severe, especially in Europe, and the demand for energy product, especially natural gas, is going to be high. Now that we know Russia has turned off the pipeline for 3 days, tomorrow when the market opens, I think it's just going to react higher, okay? Because this news only came in over the weekend. So the natural gas, as far as the daily time frame is concerned, is telling me that there is a very high chance that $9.752 may be challenged one more time, and it managed to take it out. The market is resuming its uptrend, because I will have to remove this pink color box. Okay, so there's a very, very good likelihood. So the key here is $9.664. Okay, this is based on the September contract. The market here does not have any major divergence. Yes, over here it has already diverged, and the market has already corrected the divergence from here to here. You can see the market going higher and higher. Now, when you see divergence, you always have to prepare for the reversal. In this case, back in 2020, before May of this year, okay, you can see prices was going higher and higher, new higher and new high, all the way to $9.664. But the indicators are going the other way direction. Okay, you can see the market was going the other way. So basically what you can do in a situation like this, you want to join all the bottom, do a simple support resistance line. The moment the market take out, okay, the opposite direction, okay, in this case, market has been going up. If you draw a support line, the market take out the support line. It is supported by this divergence that we are seeing so clear. And eventually market actually pulls back major, okay, almost $4, more than $4, which is 50%. And this is a big move. Okay, so when the market finishes divergent, goes into oversold, then you start looking for that possible reversal in the daily time frame. Okay, so actually it's not that difficult to trade markets if you can understand the momentum. Okay, if the momentum is not following the price action, it's telling us be careful. Market can flip any moment. Okay, because if I can see it, a lot of traders will be able to see. Eventually, all the program trading will be able to capture this as well. And all they need is just one news to flip. Okay, in this case, I'm not sure what was the news that caused this market to flip. Okay, but eventually, the market actually did flip. Okay. So I finished with energy products, and if I assume you guys are not going to ask questions today, okay? So I'm going to round it up by covering the last three pair of the major coins. We will start off with Bitcoin. Bitcoin came off, okay? But for the week-to-week basis, it's actually still positive. Yesterday was still down. Today was a bit of a rebound. Today I managed to go back in and sell, okay? During the sell-off, I was holding on to short position. I think Thursday I covered back everything, and then I have no position for Friday, Saturday. And then as the market continued to go lower, I just waiting for that rebound. So this afternoon I saw a rebound. I managed to go back in on the short side. Okay. So let's continue. On the Bitcoin side, on the weekly time frame, we can see the market is basically in the bearish mode. Okay. As far as the weekly time frame is concerned, this market is bearish. And the low so far this year is 17,592. This low has a very real risk of revisiting again, because this week, although it has not finished yet, okay, we still have a couple of hours left before the week is over. A high of 25,212 has been traded, and this is an outside bearish bar. Okay, even unless the market goes back up again in the next 4 hours and close above 25,212, which is highly unlikely. I think it's going to wait. It's possibly going to end somewhere around here. This chart is updated up to 6:30 this evening. So it's as updated as I can give you, okay? And the last price I saw was 21,000, just below $400, okay? So it's highly unlikely to actually go back up to 25,212. So if it closes around here, this is what we're going to see, an outside reversal pattern on the favoring the downside. So if this is the case, there's a very good chance the 17,592.78 will be taken out. And if that's the case, I think it has a good chance of challenging this spike. My target here is 12,185, 185, correct. 12,185 is my immediate target. It could go down as low as 7,006. Okay, anywhere between this bracket of prices, I will start looking for that potential buy signal. Okay. In the daily time frame, the market is barely holding on to this support line. Okay. Friday, we saw this massive sell-off. Okay. And then the market started to stabilize over the last Saturday and today. So it's barely hugging this support line. If it fails to hold, it will continue to go down. Okay. And if it goes down below this point here, I can't see my price here. Okay. It's definitely somewhere just above 17,592. And then I will have to eliminate all my green color boxes and keep only the pink, which is very, very bearish. Okay. And you can see the market is not oversold yet. So there is still some potential to go down. Okay. So going forward over the next 48 hours, I do expect prices to continue extending lower. In the Ethereum, we can see that it's not an outside bar. Ethereum actually on the relative basis is actually quite firm, because we are talking about a merge of blockchain technology. Right now we have this proof of work moving on to the proof of I think it's proof of stake. Okay, I can't remember what it is. Okay, anyway, there is this migration over to a new blockchain technology, which supposedly make it even more efficient for this coin here. So the date in which most people speculate in which they will successfully merge the two technology into one will be on September 13 to 16. I think it's 16. Okay. So this coincides with the FOMC meeting. No. Yeah, correct. FOMC meeting is on February 13. So happening so close to FOMC, and for us, we have seen the correlation between cryptocurrencies and especially the Nasdaq, for example. Then if both flip at the same time based on one single event, there is always that possibility. So do watch out for that concurrent happening at about the same time, okay, between September 13 to September 16. So prices has been coming down and they are all in pink color. It means the same market is still very bearish, but it actually, this is a three wave. I can see that here is a three wave. So three wave is corrective. So if this is three-way corrective, it actually hit my target, just missed my target by just $7. My target was $873.37. It came out to $880 and then started to stop and then started to reverse. So technically, you can say that market has or may not have hit this target. So if you're very strict about these targets without giving allowance, then I say, okay, you have not hit target yet. But based on visual inspection, I think it's more or less can be said to have hit target. Okay, so this rebound here could be the start of a new trend for all we know. Okay, because if this is an ABC, then this low should actually hold. Okay, so unlike Bitcoin, which I think may have a chance to come back down again. Okay, Ethereum on the relative basis, I think even if it come down, you will on the relative basis, I think it will be firmer than the Bitcoin. So if you are looking to buy, this is actually a good coin to consider. Okay, I will actively look to towards buying this coin rather than Bitcoin. In the daily time frame, you can see the market has broken out of this support line. Again, in the middle of this week, this move here on Friday was very severe. Okay, followed by Saturday, another dip down to 1,524, and then it balanced there. Today is an inside bar. It can swing either way, but I think it's likely to go lower. If the market goes over the next few days below 1,356, I would consider this rebound as over. And this could be part of the first leg. Now we'll be seeing possibly a second leg. And if it's also a three-wave pullback, then there is still hope for the market to rally. Okay. Because this high here, 2,031, doesn't look complete to me. Okay. I am thinking this is part of a three-wave. And this is the start of a fourth wave. So long as this come down in the three-wave pattern without taking 1,356, I think it is still safe to say that there is still a very good chance that this market can extend even higher. My key level here is 2,160. Okay, so you can see that I'm slightly bullish on Ether compared to, let's say, Bitcoin. Okay, because they have different dynamics altogether. Ripple, I've just re-established my short position. I have not been trading Ripple for weeks on end, but it has been struggling. Okay, so when the market sell off, it came down together with the rest, and this market is trying to rebound to this afternoon. So I managed to re-establish my short. Although the area in which I re-established my short has been very far away from my ideal price, but any kind of rebound is, to me, a reason to get back in selling this coin. Okay, so this market is very, very bearish. The high traded was $1.96, gone up all the way down to below 30 cents. Now it's bound back to 41 cents. Today, this week is actually down. Okay, for the last 2 weeks, it has been doing what we call a double inside bar. Okay, not knowing which way to swing. Okay, but this week I think it resolved the downside. I think it won't be too much of a stretch for the market to go even lower. Challenge to 0.17. Ultimately, I think this is the level to watch. 0.127. Okay. On the day time frame, you can see Friday was a massive sell-off. There was an inner support line followed by an outer support line. Now the market has already broken the inner support line on Friday. Prior to this Friday move, the market was still holding on. Okay, so the market has been basically flat for more than a month. Okay, nothing happened in Ripple. Okay, and then it started to sell off big time on Friday. So based on this bar alone, I think the market is likely to go even lower, possibly below 0.2878. 2870. Okay, so in the market is not technically oversold yet, so there is still room for the market to go even lower, at least to challenge this low here of 0.2870. Okay, so there you have it. I have finished all that I want to share with you. If there's anything else you want to talk to me, you can reach out to me by email. Most of you are following me by Facebook. You can send me a note on Messenger. And if there's any one market that you want me to cover, do write to me during the week itself so that I can prepare to share with the rest that one particular product. Knowing that I don't trade equities, anything else is fair play. I do watch all the other markets. I don't trade equities per se, okay, but I just want to know where the general markets are all heading. All right, guys, if you have no question, I will end here. But if you have question, let's give ourselves maybe another 1 minute more before we close the session. Dennis, what do I think is a good entry for gold and silver to hold for inflation recession? Now, both metals has not been behaving like a hedge against inflation throughout this entire 6 months. The books has been telling us in inflationary period, precious metals should rally, but we are not seeing that at all this year. So the story about buying precious metal as a hedge against inflation is no longer valid as far as we can see, because it's just not behaving as it should. So if you are looking to buy gold and silver, earlier on when we talk about the precious metals, those are the levels in which I do not believe we are in a bear market for gold and silver. Silver may be so compared to gold, okay? But both will do very, very well going forward over the next few years. I have always advocated do not trade precious metals per se because they are heavily manipulated by the bullion banks, okay? I would want to go in and buy the physical. For silver, I would like to buy the coin. I would like to buy silver coin. And I would like to buy, my favorite is always the maple coin, which is a Canadian coin. Okay. And if you can buy from a bona fide dealer, go ahead and do it. And don't buy one coin because it's so cheap. You buy, let's say you got a budget for $1,000, just buy $1,000 worth of coin and just put it aside. And I think we are coming to the point whereby it's becoming very attractive to buy silver coins. Okay, gold may be a bit more expensive relative to gold. Compared to silver, then maybe if you want to buy gold, I still recommend do not buy the coin, buy the bullion bar as much as you can afford. Okay, buy the biggest possible brick you can find. Okay, trading of precious metal can be very, very tricky. Okay, so again, if you have any questions regarding entry level, follow me every week. I know when I talk about levels, you want to take note. Okay, next question, Jim is asked me, may I know how high inflation will affect GDP? How does high inflation affect GDP? When you have high inflation, it means people are suffering. So they have to prioritize their expenditure. What are the expenditure they can do without or they can delay? What are the things that they cannot delay? Shelter, you got to pay. When your rent is up, you got to pay. When the mortgage is up, you got to pay. Okay, that one you cannot delay. Okay, and then food, maybe you can substitute with maybe not the high, the very valuable food. Maybe you can do without lobster. You can go with prawn, for example. And if you have to take protein, you have so many different sources of protein. So you have to make priority. But the net effect is that spending will come down. So in the economy, when most of the people are reducing their expenditure, obviously in a high inflation environment, everybody will be looking to spend less if they can. Okay, so the net effect on the GDP is definitely a lower GDP. Okay, so if that is being accompanied by very high interest rate, which is what we are seeing, it's just going to compound the problem because you have destroyed the demand equation. Okay, and if that's the case, even lesser consumption will happen in the economy, and the economy does over a period of time will go into a recession. And if this thing continues over a period of time, there is a very high likelihood we're still going to see high inflation and with little or no economic growth, in which we will have a classic definition of a stagflation. And in a stagflation, it's going to be even stickier. It's very difficult to get out of a stagflation. Japan has been in stagflation for 3 decades. It's never managed to get out of it. So a stagflation is very, very serious. Okay. So yes, high inflation will definitely negatively impact the GDP. Okay, Vivian is asking, what is my view on sovereign debt crisis? Yes, this is going to be the next big item that we are talking about. Beyond inflation, at the rate central banks are hiking interest rate, it will cause another problem. Another problem will be the amount of debt that the world has accumulated since the global financial crisis. Is all going to come to a head because days of cheap credit are gone. Okay, we are going to see the cost of debt is going to escalate because the cost of servicing those debt is going to be progressively more difficult as interest rates starts to go up. Okay, so at one point, where will it lead? The West is prepared to not pay. They are prepared to default on all this external debt they have. They are going into what we call a global reset. Let's reset the rule all over again. Forget about all debt. Let's start over again because they have no means to pay. So yes, the sovereign debt crisis will come to a head, and it will likely happen in the Eurozone. Okay, this year is just everything coming together at the wrong time. We have inflation, we have lower economic growth, we have a war in Ukraine that's threatening to spill beyond Ukraine or even to extend beyond the year 2022. Okay, and then we have weather condition right now above in the northern hemisphere. We have drought happening from northern America all the way to Northern Europe to all the way to China. So this weather, the drought situation is so severe, a lot of old, sites that have been buried under the water because of the dry season, the riverbed has all dried up. They are able to see things that they were not able to be seen. For example, monuments, okay? So you can see that this drought is going to be so severe, coupled by the fact that they have missed the planting season because of the ban on the export of fertilizer from Russia. So the planting season is well behind us already. So the net effect will be next year, more severe inflation. Okay? Coupled by the fact that we're having a drop across the entire Northern Hemisphere. So food production will be a major issue going forward. So next year, I do believe next year we're going to see even more severe food inflation. Okay, so it will compound all the problems that we are facing based on what we see. Is a current inverted yield a strong signal of the recession? Yes. It is unnatural for far-dated bonds to have lower yield. You should have higher yield, but the yield is inverted. Okay, so basically what it means is that the short-term treasuries, okay, are having higher yield compared to the long-dated yield bonds. Okay, it makes no sense because you have time on your side. Why should the far-dated bonds that are 10 years having a lower yield compared to the front month like the 2 years? Okay, so this is always a signal that things are not right. Okay, so usually when people look at the yield curve, they look at if the yield curve is inverted, which is very unnatural, then yes, we are possibly looking at a recession. David said, thank you very much. And he said, given that we have higher inflation versus higher interest rate, which one will they sacrifice? They will sacrifice the economy, that's for sure. We are already seeing that already. If you've been following my Facebook, every day I have put up certain sharing of certain articles and I put in my comment. Of late, I've been talking about if the Federal Reserve continue its current path of higher interest rate, okay? How do they know that they are beating inflation? They believe, when I say they, I'm referring to the central bankers, they believe that only when you see unemployment rate starting to pick up, then they say, yes, my higher interest rate is finally reducing demand. They want to see reduced demand, okay? Because when companies are having headwinds, because interest rates are going up, the cost of money is going up, they will reduce production, okay? And they will start to lay off because demand is weak, okay? So if that happens, more people will be left without a job. Now, the one key data we have to watch are the employment numbers. Right now, unemployment rate is very stable, both in the States, in Europe, in UK, is very stable, even in Australia, very stable. But the moment this unemployment rate start to pick up, okay, that's when we see that they will not stop until they see unemployment rates picking up. Right now, it's still stabilizing. It's already stabilizing. Okay, is it going to go down even lower? Highly unlikely. Okay, what we're going to see is that a plateau and then start to spike up. So prepare for higher interest rate, prepare for a higher unemployment rate, and that will lead to a recession. Okay, here it says that obviously the Fed cannot do Volcker's way. Obviously not. Volcker is, by the way, the ex-Federal Reserve chairman, in which the way he tackled high inflation back in the 1970s and 80s is to hike interest rate double-digit, okay, into the double-digit to fight inflation. You must understand, in the 70s, the economic theory is based purely on consumer demand. But over the last few decades, we see the consumer is having a reduced role. Governments are getting bigger and bigger and bigger and bigger. So all the debt that is, we base the theory on consumer debt. You can hike interest rate to the point whereby consumer will feel the pain and stop consuming, and inflation will come down. But when the inflation is caused by big government, higher inflation is not going to do the job, because right now the debt level at the sovereign level, at the government level compared to the individual consumer level is lopsided. The biggest debt right now is accumulated by governments around the world. So higher interest rate is not going to do the job. Okay, so the vocal way will never be used. Or if they use back the vocal way of trying to increase interest rate to tame inflation, I think they're barking up the wrong tree. Okay, because the nature of inflation is very different. 50 years ago, it's consumers. Now it's big government. So big government need to reduce in size, but they can't, because they just go on getting bigger and bigger and bigger and bigger, and all the debts are being accumulated by governments. Okay, so we have a very serious situation here in which they're using the wrong theory to tackle an old problem. Okay, some say economists, analysts saying the employment data is lagging. Yes, it's lagging. What is my opinion? Obviously, all the data that we get are all lagging. Okay, and some of the data need revision. But this is the best we have. There's no real-time data which that we can use. They are all backdated. Okay, means to say that it has to happen first. Then we take time to compile the data, and then we start to analyze. It's always late. Just like technical indicators, they are all late. They are all lagging indicators. But that is the best we have. Is there any forward way to look at it? Yeah, look at cycles. Cycle may be the only way you can look forward. Okay. All right, guys. Your question come very late, but I like it. At least you ask question. Thank you very much. And what can we do to save ourselves? Start prioritizing. Okay. If your income is fixed, if you are working and drawing a fixed income, you got to start prioritizing. Okay. If you got outstanding loan, talk to your banker, see if you can somehow manage to get a fixed loan, whether it is your utility bill, talk to your utilities provider and see you can fix the rate, because most of these services are based on floating rate. Okay. And now that the energy prices has come back down a little bit, okay, this could be your last chance to lock in the rates. Okay, because going forward, it's likely to go even higher. So if you can talk to your services provider, any kind of floating rate you want to lock in. Okay, unfortunately, most of the loan rates are variable, because the banker also do not want to hold the stick. They also want to make sure they protect themselves by charging you a premium based on whatever the rate is. Okay, so they are not about to fix the rate and then suffer the consequences if rates goes up. So, but you got to try. Okay, then among your expenditure, start to cut down the unnecessary. Okay, take public transport if you can. In Singapore, it's easier for us. For Malaysia, it's a bit more difficult. The country is so big, so maybe you can change into a more fuel efficient car. Okay, think places where you think you can cut, you cut. Okay, forget about eating out so often. Okay, those become luxury, and stop ordering food delivery service. Those extra fee that you pay can be saved as well. So again, you have to start prioritizing your expenditure. If you got kids that you send overseas for study, find some way to lock in the exchange rate. If you're Malaysian, you know your ringgit is falling every day. Then if the market actually reverse, give you a chance, because the market is diverging, by the way. If the dollar actually diverge, basically the trend diverge, then you have a chance to actually lock in your overseas foreign currency rates. If you send your children to Australia, the Aussie is also falling in tandem with the Malaysian ringgit, but it is still, I have not checked the Aussie versus ringgit, but look at the chart itself and look at a price in which you can lock in the rates. Okay, if you can afford to lock in the rate, you lock in the rate, because if you don't lock in, the ringgit is likely to continue to spiral out of control, because all emerging markets is going to suffer in an environment in which the dollar continues to go higher and higher on higher interest rates. So that is the trend. The dollar is unlikely to come down anytime soon. Okay, so that means all emerging market currency is going to come down, and Malaysian ringgit is one of them. Okay, even Singapore dollars is also falling, but it's not falling as bad, because we also need a strong Sing dollars to make sure that we don't import the inflation into, because we basically have to buy everything that we need: food, water, supplies, raw material, everything we need to import. So we need to have a strong Sing dollars. So on the relative basis, maybe we may be shield from the real inflation that the rest of the world is facing. Okay, so this is how you can save yourself. Start prioritizing your individual expenditure. Things that are happening, you have no way of controlling, and stay invested. The only way you want to get out of this hole is to stay invested. If you just save, you can maintain, okay, but you are not able to overcome. So I always say, stay grounded, stay basically well tuned to the global trends, and then if the chance presents itself, you still want to stay invested. Okay, obviously certain asset class will do better, some are not doing so well, so you have to rebalance that portfolio that you have, whatever you have. Okay, whether it's real estate or whether it is equities, you have to rebalance them. Okay, guys, if there's nothing else, I would like to close this session. I'd like to thank you guys for this attendance. Today's attendance is pretty healthy, and I have a recording of this. If you want a recording of this, do let me know. Send me a message either by Messenger or by WhatsApp if you have my number, and of course you can always write to me via email. Okay, guys, thank you very much, and I look forward to seeing you again next Sunday. Bye.